Hello everyone, welcome to Lecture 2, which is continuing our discussion on banks. Today we focus primarily on off-balance sheet activities. So this material comes from chapters 12 and chapters 11 in our textbook. Our learning objectives today are first to understand what are off-balance sheet assets and liabilities. These include loan commitments, letters of credit, loans sold, and derivatives. We will also discuss how does a bank make money, and then what else should I know about banks? So we'll talk about the Financial Services Modernization Act of 1999 and also the impact of the European sovereign debt crisis on banks. So first, let's discuss off-balance sheet items. So off-balance sheet items are contingent assets and liabilities that may affect a commercial bank's balance sheet and or income statement. Let's break down this definition a little bit. So first of all, a contingent asset. This is a possible asset that may arise because of a gain that is contingent on future events that are not under the entity's control. Now, vice versa, you would have the same thing with contingent liabilities, a possible loss that may arise on an event that is not in the entity's control. Commercial banks are they're very similar to savings institutions and credit unions. The biggest thing about commercial banks is that the size of their loans and deposits are much different than your typical savings institution or credit union. But commercial banks are the largest group of depository institutions if you measure by asset size. And so these off-balance sheet items are in effect because of today's accounting standards. So with today's accounting standards, a business does not recognize a contingent asset even if the associated contingent gain is probable. So you only realize the gains or the losses on these off-balance sheet items once the actual event is realized. So these different off-balance sheet items include loan commitments, letters of credit, loans sold, and derivative contracts. We'll talk about these and do some examples on the upcoming slides. But to keep in mind, or to wrap up what an off-balance sheet item is, it means that they are not currently on the balance sheet, but they may at any point appear on the balance sheet and then as a result impact revenue and or expenses. So why do banks enter into these off-balance sheet items, or why do they have these off-balance sheet items? They do this to earn additional income, which could help complement declining margins or spreads on your traditional lending businesses, so your traditional loans. The thing about off-balance sheet items is that they are less obvious, and oftentimes they are invisible to financial statement readers. So they usually appear below the bottom line. It's very difficult to see them until they are actually realized by the different banks. So let's go into detail on each of these different types of off-balance sheet items. The first is a loan commitment. A loan commitment is a contingent asset. So it is a contractual commitment by a bank to lend a client a certain maximum amount at a given interest rate over a certain period of time. Now, most of your commercial and industrial loans, so think back to lecture 1 of this unit, so dealing with capital expansions and any other capital needs, maybe a small business might take out a commercial and industrial loan, but most commercial and industrial loans are loan commitments that are taken down rather than spot loans. So remember what on the spot means, or a spot rate. A spot loan would just be the loan that occurs on the spot, so it occurs when you initially enter into that particular loan. These loan commitments are taken down and they're not realized until the loan amount is actually distributed. For a loan commitment, the bank charges the client an upfront fee for making the funds available on this loan commitment, and then when the loan is taken down, actually realized, that's when it becomes an asset on the balance sheet. So to help with our understanding of what a loan commitment is, we have a brief example. So in this example, you want to start a takeout frozen yogurt business in Athens, and you estimate the startup cost of $100,000. You can do a traditional loan where you take out a loan of $100,000 now, so this would be a spot loan at a 5% interest rate, or what you can do is you can enter into what is called a loan commitment with a bank where you take down up to $100,000 over a 12-month period for an upfront fee of 0.75% or $750. So you take out this loan commitment, you pay the $750, and what is with the banks is they have this off-balance sheet item. Nothing is realized until the actual loan amount is actually distributed. So let's look at it by looking at a timeline. Time period 0, you paid your $750 for this loan commitment where you can borrow up to $100,000. Let's say in 1 month, you choose to take out $50,000 of this $100,000 loan commitment. So this now would be appearing on the bank's balance sheet as an asset, a $50,000 loan, because they're getting interest from you on that $50,000 that you borrow. But there's still $50,000 in the shadows that could transfer onto the balance sheet at some point into the future. So they could actually realize up to another $50,000 of assets on this loan commitment. But right now it's only $50,000 on the balance sheet as an asset for this particular bank. Let's say in another 3 months, you take out an additional $30,000. So now another $30,000 is transferred over to the bank's balance sheet. So now they're showcasing $80,000 in loans on their balance sheet, but there's still this $20,000 that is what is referred to as in the shadows that could transfer onto the balance sheet at some point. Going another 2 months, so now we're 5 months in, you take out an additional $10,000. So now the loan balance on the balance sheet for the bank is showcasing $90,000, and then at the end of 10 months, you take a final $5,000 out. So the bank's balance sheet is showcasing $95,000. You only borrowed $95,000. What the beauty is in this particular, or with a loan commitment, is that you're only paying interest on the amount that you take out when you take it out. So you're not paying interest on the full $100,000 like you would if you did a spot loan. 1 month in, that's when you start paying interest on that $50,000 that you first borrowed. 3 months in, then you're starting to pay interest on the total of the $80,000. So the bottom line is, with the loan commitment, you end up only needing $95,000, so you only pay interest on $95,000 instead of $100,000. And also, you're not paying interest on the whole $95,000 from day one. You're only paying interest on what you've taken down so far. For that flexibility, you pay that upfront fee of $750. So there is a small typo there. One thing that I forgot to mention, I did add these after I first provided the course pack. So there is a document on Blackboard titled Lecture 2, Off-Balance Sheet Activities Examples. You may want to print that out, and these are available there on Blackboard. Okay, second type of off-balance sheet item is a letter of credit. A letter of credit is a contingent liability for a bank. The previous loan commitments were a contingent asset. These are a contingent liability. There are two different types. First, you have a commercial letter of credit. This is often used in trade, where the bank formally guarantees that payment for goods will be made even if the buyer defaults. And you also have a standby letter of credit. This is where the bank will step in if the bond issuer defaults. So essentially, they are acting as insurance for the bond holder. These have higher risk than a commercial letter of credit. Why? Because it's not just a one-time payment. It could be transactions or payments over a longer period of time. So for example, under a standby letter of credit, a bank pays a principal payment when it comes due if the issuer defaults and is unable to make their payments on that particular bond. Now you might be a little confused. I do have two examples of a commercial letter of credit and also a standby letter of credit. Once again, these are on the extra document on Blackboard for those of you that would like to print this off and follow along as well. So first, let's look at a commercial letter of credit. So here we have a U.S. pipe manufacturer wanting to buy $1 million worth of copper from an Australian copper supplier. The Australian copper supplier asked that the U.S. pipe manufacturer obtain a commercial letter of credit from a U.S. bank before they signed the contract for the shipment. What does this mean? Well, let's look at a very basic diagram. Here we have our Australian copper supplier. And then we also have our U.S. pipe manufacturer. So the U.S. pipe manufacturer wants to buy $1 million worth of copper. So the Australian copper supplier will send over $1 million worth of copper. And in exchange, the U.S. pipe manufacturer will pay $1 million. However, the U.S. pipe manufacturer has to have a commercial letter of credit. So you have this commercial letter of credit that they have entered into, which states that in the event that the U.S. pipe manufacturer is not able to pay that $1 million, the bank will step in and make that payment in the event that the U.S. pipe manufacturer would actually default and not be able to make that payment for the $1 million worth of copper. So what you have here is you have your U.S. bank, which is essentially co-signing on the contract. So if this U.S. pipe manufacturer would default and not be able to make their $1 million payment for the copper, since the Australian copper supplier required that the U.S. pipe manufacturer's first entered into a commercial letter of credit. If they default, the U.S. bank would then step in and make that payment for the U.S. pipe manufacturer. So, as I mentioned, they are essentially co-signing on this contract, and for the U.S. pipe manufacturers to have this kind of support, what the bank will do is they will charge an upfront fee to take on this additional risk. So that is a commercial letter of credit where the U.S. bank would step in for the other side of the transaction if they are unable to make the payment for the product. And as I mentioned, the commercial letters of credits are often used in trade by these different suppliers to ensure that they are actually receiving the funds that are initially agreed upon within the transaction. So next up would be a standby letter of credit. So with a standby letter of credit, a biotech firm, for example, a biotech firm is issuing a 5-year, 10% annual coupon bond that will be privately placed with an institutional investor. The institutional investor agrees to buy the bond only if the biotech firm secures a standby letter of credit with its bank. What does this mean? So once again, we have our institutional investor wanting to purchase the bond from the biotech firm. So what ends up happening is the biotech firm issues the bond that also has interest payments that are associated with it, a 10% annual coupon, and in exchange, the institutional investor pays cash to the biotech firm. Now, before the institutional investor purchased this bond, they required the biotech firm to obtain a standby letter of credit, which said that if the biotech firm defaulted on their interest payments or principal payments, what would happen is the bank that entered into this standby letter of credit with the biotech firm would then step in and make the payments on behalf of the biotech firm. So the bank is going to make these payments, and why this standby letter of credit has more risk than a commercial letter of credit? Well, this is all remaining payments. So in the previous example, our commercial letter of credit, the U.S. bank stepped in and made the full payment to whatever was necessary for the $1 million worth of copper. In this particular example, let's say the biotech firm defaults in year 1. If they default in year 1, the bank's going to have to make 4 additional years of interest payments plus the principal amount. So it's not just a 1-year payment, it's payments that could occur over an extended period of time. And similar to the commercial letter of credit, the banks will charge an upfront fee to act as this standby in this standby letter of credit in the event that the biotech firm defaults and is unable to make their payments on this particular bond. So those are letters of credit. So we've talked about loan commitments, and we've also talked about commercial letter of credit and standby letters of credit. Our other off-balance sheet items are loans sold. So loans sold are loans that a bank has originated and then sold to other investors. We have a new terminology here with loans sold. It's called a loan sold with recourse, and it means that if the credit quality of the borrower deteriorates, the loan purchaser can resell the loan back to the bank. So essentially, if something is sold with recourse, the seller bears the responsibility for the sold asset. And so if it turns out to be defective, they have to repurchase that asset. If a bond or if a loan is sold without recourse, then the buyer of that loan or the buyer of that asset accepts the responsibilities associated with purchasing that item. Loans sold with recourse represent an off-balance sheet credit risk. So the credit risk just meaning the credit quality of the borrower decreases and defaults, then the loans are sold back to the bank. So that's what I'm referring to here when I say about an off-balance sheet credit risk. And so let's look at an example. Goldman Sachs buys a group of mortgages from Citigroup. So Citigroup originated these mortgages and then sold them to Goldman Sachs. And then these loans are sold with recourse. What does this mean? So once again, we'll do a pretty basic sketch of the transaction here. Here we have Citigroup originating these mortgages and then selling them to Goldman Sachs. Goldman Sachs then would obviously pay cash for these or pay some monetary amount for these different mortgages, and they are sold with recourse. If they are sold with recourse and all of a sudden the mortgage borrowers start to default, then Goldman Sachs can sell them back to Citigroup, and Citigroup would have to pay Goldman Sachs to buy these mortgages back. So in the event that these mortgages actually start to default, then this is what our new chart would look like. You'd have Citigroup having to buy back the mortgages from Goldman Sachs, and in doing so, they would end up having to pay money for those mortgages. So as kind of a recap, if the loans default, Goldman Sachs returns the loans to Citigroup, and Citigroup has to buy them back from Goldman Sachs. As I mentioned, these loans originally became an asset to Citigroup, but as an asset, they actually increased the credit risk of Citigroup. Increasing the credit risk just meaning that if the mortgages actually do default, they have this credit risk associated with them. By selling these groups of mortgages to Goldman Sachs, if they end up defaulting, then they're going to be required to buy them back since the loan was sold with recourse, and that is a credit risk on the behalf of, or from the point of view of, Citigroup. Last main category of off-balance sheet items are derivatives. So think back to Unit 3 where we talked about 4 main types of derivatives. Banks use derivatives to hedge, so to mitigate risk or to act as the middleman in trades, so being the swap bank. By using derivatives, banks are exposed to the risk that the counterparty will default. So remember from Unit 3 that counterparty risk is higher for non-exchange traded contracts, so those contracts that are not traded on some secondary market, and those examples from Unit 3 included swaps and also forwards. So why are banks so involved with derivatives? So large banks are very much involved with derivatives, and it occurs primarily due to 3 main reasons. The first is the Financial Services Modernization Act of 1999. What this act did was it mitigated, or it repealed the Glass-Steagall Act, which the Glass-Steagall Act actually prohibited commercial banks from engaging in investment banking under the same roof. So investment banking is basically the creation of capital for other companies. So you have like underwriting, mergers and acquisitions. With the Financial Services Modernization Act, you were now able to have both commercial bank and investment banking occurring under the same group. So for example, a bank like Citigroup, they're now able to add revenue without adding to their balance sheet. These are off-balance sheet items, so they could enter into these derivative contracts that would end up adding revenue once they're realized, but they're able to add these different revenue streams without actually changing their balance sheet, since they are off-balance sheet items. Another reason why banks are so involved in derivatives would be for hedging, so once again, mitigating risk. Your small banks, so your community banks, for example, I'm sure many of you guys have heard of Hocking Valley Bank here in Athens, or in Hocking County. Small banks, these community banks rarely hold derivatives, but large banks are very involved in derivatives. However, this is because large banks are considered too big to fail. So the thought is, if the large banks were going to have some type of financial problems, they assume that there would be some type of government intervention that would that makes them less reluctant to actually take on the risk. So they actually feel like they can take on this additional risk because they know that in the event that this would have a significant impact on the economy, that they think that some type of government intervention would occur on these derivatives, or on this in this scenario. So moving forward into how banks make money. The first being something that we discussed in Lecture 1, which is the interest rate spread. The interest rate spread is simply the difference between lending rate and the deposit rate. So let's say you give out a mortgage or a loan and you're charging 5% interest on that loan, and then on all deposits you're paying 1%. Your interest rate spread would be 4%. So this was discussed in Lecture 1, just the difference between your lending rate and your deposit rate. You also have non-interest income. This is income not generated by interest on assets, so interest on, for example, like your loans for a bank. And they earn this non-interest income through derivatives, discussed previously, also through trust services, which is managing estates and pension funds assets, and also through correspondent banking. So correspondent banking is when small banks with insufficient staff buy services such as check clearing, foreign exchange trading, hedging, large loan issuances from larger banks, and deposit cash at these larger banks as payment. So essentially, you're outsourcing your activities as a small. This includes outsourcing the activities to a larger bank in exchange for depositing cash at those larger banks. So Small banks and large banks are fundamentally different. Let's look at some differences, focusing first on large banks. Compared to small banks, large banks have less core deposits as a percentage of total assets. Core deposits typically are funds of local customers who also have a borrowing or some relationship with the bank, so less core deposits as a percentage of total assets for large banks. Also have smaller net interest margin, so once again, interest income minus interest paid on your interest earning assets. They do operate with more derivatives. They have more off-balance sheet activities. The first four items that we talked about today, the loan commitments, letters of credit, loans sold with recourse, derivatives, they do have more off-balance sheet activities. And then they also have less equity capital relative to total assets. So this basically wraps up, this does wrap up our off-balance sheet activities discussion. To conclude today's lecture, what we'll do is we'll look at some other facts in regards to banks. Most of you are probably familiar, as we've mentioned it quite a few times already, and you probably just are more aware of the financial crisis of 2007. Kind of discussed it in Unit 1 when we briefly introduced mortgage-backed securities. But another crisis that you might not be familiar with is the European sovereign debt crisis. So what was the European debt crisis and what was its impact on banks? Well, first of all, in spring of 2010, Greece, a member of the European Union, was on the verge of defaulting on its government debt. And so what ended up happening was there was a fear that there would be a collapse in the euro. What this led to was a bank run. People rushed to their banks to take out their money from these banks. This also happened in the early 1900s here in the United States in 1907. This was when the Federal Reserve was actually created due to this bank run, which includes people rushing to get their money out of these banks. The crisis spread to Portugal, Spain, Ireland, and Italy. And the banks end up losing billions writing down debt. So writing down debt is just non-collectible debt, removing it from the balance sheet. But then in May of 2010, the European finance ministers and the International Monetary Fund approved a $147 billion rescue package and a $1 trillion safety net, and the crisis was actually averted. Last up on today's discussion is discussing credit unions. So in addition to a bank, you might want to consider a credit union. So it is another depository institution who is technically not a bank, but a credit union is a nonprofit depository institution mutually organized and owned by their members, their depositors. Members are required to have a common bond of occupation, so you may have university affiliated or company affiliated or just covering a well-defined neighborhood or rural district. The company you end up working for may have a credit union, but credit union deposits are used to provide loans to other members in need of funds, and the earnings from the loans are then used to provide interest on the deposits. Because credit unions are nonprofits, earnings are not taxed. Therefore, credit unions can offer higher deposit rates and charge lower rates on some loans than banks do. So essentially, the members are the depositors, they are the contributors, and then the other members pay interest on their loans, which fund those savings accounts. You may want to consider credit unions because they do oftentimes offer higher yields on deposits and lower rates on loans. But as I mentioned, to be a member, you have to have some type of common bond of occupation. So university affiliated, company affiliated, well-defined neighborhood, but those are credit unions. So wrapping up Unit 2 or Lecture 2, reviewing the concepts. What are off-balance sheet assets and liabilities? So these are contingent assets or liabilities that are not located on the balance sheet until realized. What are loan commitments? So this is loaning a particular amount that is taken down over periods. What are letters of credit? So guaranteeing payment. We talked about commercial letter of credit and standby letters of credit. What does a loan sold with recourse mean? So that means that it could be resold back to the banks. And why has the use of derivatives by banks increased? One would be the Financial Services Modernization Act of 1999, also because of hedging and also because of the thought that banks are too big to fail. How does a bank make money? They make money on the interest rate spread and also on non-interest income, which includes derivatives, trust services, and correspondent banking. What effect has the Financial Services Modernization Act of 1999 had on banks? Well, commercial and investment banking could be conducted underneath the same roof, increasing the use of derivatives by banks, and so now they were actually allowed to have these proprietary investments They were allowed to engage in investment banking activities. And then what was the European sovereign debt crisis? This is the concern of Greece defaulting on its government debt. And then what is a bank run? A bank run is when individuals go and pull out all of their funds from their banking accounts. So that wraps up Lecture 2. Be sure to fill out or to complete the lecture question on McGraw-Hill Connect, and I will talk to you all soon. Thanks.